Welcome back to Talk Tickers. This is the show for the professional investor where we strip away the PR fluff and get right down to the hard numbers.
Numbers that actually move the markets.
Exactly. If you're listening to this, you aren't here for a quick soundbite. You are here for the alpha.
And today's deep dive it's a really big one.
It is massive. Today we are breaking down the Q4 2025 earnings call for the offshore drilling giant, Transocean, ticker symbol RRIG.
Right.
And man, if you were watching the tape on Wednesday morning, you probably got a bit of whiplash.
Oh, absolutely.
Because if you held Transocean stock at 9:30 a.m., you were sweating. It was a
classic example of the market reacting before it actually thought.
Right, before anyone read the actual release. So let's set the scene with the immediate price action, because this tells the whole story of the conflict we are solving today.
Yeah, let's do it.
The print drops.
Yeah.
The algorithm scanned the headlines. And immediately in the pre-market, the stock gets hit. It was indicated down nearly 3%.
Trading around, what, $6.17?
Yeah, exactly. $6.17 right after the news hit the wire. It looked like a total rejection of the quarter.
Because the knee-jerk reaction was negative. The bots just saw a miss.
But then the market opens, the actual earnings call happens, human beings read the release, and by the closing bell, the stock finished the day at $6.52.
Which is up over 2.5%.
Right. And on volume, that was double the long-run average.
Something like 53 million shares traded.
Yeah, 53 million.
Yeah.
So someone, or really a lot of someone, stepped in and bought that dip super aggressively. And that is the mystery we are solving today. Why did the market dump it initially and then aggressively buy the dip by lunch?
It really, it comes down to a classic battle between two different ways of valuing a company. It's accounting optics, what the headline numbers look like versus cash reality.
What's actually hitting the bank account?
Precisely. And in the offshore drilling world, those two things are almost never the same.
Okay, let's unpack this. Let's start with the reason for the head fake, the bear case, the headline miss. What exactly did the bot scrapers see that made them hit the sell button?
It was the earnings per share. Non-GAAP EPS came in at 2 cents. 0.002 cents.
Okay.
Now, consensus on the street, what the models were looking for was roughly 8 cents.
So they missed by 6 cents.
Right. And in percentage terms, that is a huge miss. If you are just an algorithm programmed to trade off earnings surprises.
Flashing red light.
Exactly. You see a miss of that magnitude, you just short the stock.
But hold on, we always talk about this.
Right.
We tell people to look past EPS in this specific sector.
Mm-hmm.
Why does the street still get this so wrong? Is it just lazy modeling?
I wouldn't call it lazy, but it's rigid. In a capital-intensive industry like offshore drilling, EPS is just heavily distorted by depreciation.
Right, the assets.
Yeah, you have these massive assets, drill ships that cost hundreds of millions of dollars to build, and you are depreciating them over decades. That is a non-cash expense.
It lowers your accounting earnings, but it doesn't actually touch your checking account.
Exactly. It's noise.
So the bear saw a 2-cent profit and panicked. But if you only trade off those headline bots, you got burned shorting this. Because while the earnings missed, the top line, the revenue actually beat.
It did. Revenue came in at $1.04 billion. Consensus was looking for about $1.03 billion. So they beat by roughly $10 million.
Which is up 9.2% year over year.
Yeah. But the real story, and the reason the stock rallied so hard, wasn't the revenue beat either. It was what was happening further down the cash flow statement.
Okay, this is where we pivot to the bull case, the cash reality you mentioned earlier. Let's walk through those real numbers.
So we have to look at adjusted EBITDA first. That came in at $385 million.
Okay.
Which is an EBITDA margin of approximately 37%. Very healthy. But the crown jewel, the number that likely caused that massive midday reversal in the stock price, was the free cash flow.
Layoffs.
Free cash flow for the quarter was $321 million.
Wait, pause right there. $321 million in free cash flow on just over $1 billion in revenue.
Yes.
That implies a conversion rate that seems almost impossible for a heavy hardware business.
I know it's high, but it's real. That is a 31% free cash flow margin. It is an incredibly efficient conversion of revenue to actual cash. And if you zoom out and look at the full fiscal year for 2025, they generated $626 million in free cash flow.
That is just a staggering amount of cash for a company that, let's be honest, the market was terrified was going bankrupt just a few years ago.
And that's the whole key right there. The market suddenly realized that Transocean is a cash-generating machine right now. While the accounting profit looks slim, the actual cash entering the business was massive.
So the bears saw a 2-cent profit, and the bulls saw $321 million hitting the bank.
Precisely. And in this specific phase of the offshore cycle, cash is king because cash is what fixes the balance sheet.
Which leads us perfectly into our first deep dive segment here, the balance sheet turnaround. For years, the knock on Transocean was never their fleet. They arguably have the best steel in the water. The knock was always the debt.
They were drowning in it.
Yeah. It was the overhang on the entire equity story.
Right. High leverage, high interest rates. It made them a distressed trade. Investors were terrified that any slight downturn in oil prices would just wipe them out because they couldn't service the debt.
But if you listen to this quarter's update, that distressed narrative is effectively dead. Let's look at the deleveraging, because they were incredibly aggressive this year.
Extremely aggressive. In fiscal year 2025, they reduced their total debt by $1.258 billion.
Over $1 billion of debt gone in 12 months.
Gone.
And that's not just refinancing and kicking the can down the road. That is actual retirement of debt.
Yes. Total debt now stands at $5.686 billion. But here's the part that really impacts the bottom line going forward. By paying down that debt and doing some smart refinancing moves, they have cut their annual interest expense by nearly $90 million.
Think about that for a second. That is $90 million a year that isn't going to bondholders anymore. It stays in the company. It flows straight to equity value. But I got to play devil's advocate here for a minute. $5.6 billion is still a huge absolute number. Are we totally out of the woods, or is this just a slightly nicer view from the edge of the cliff?
It is a large number, you're right. But the context has completely changed. This moves the company from distressed to a sustainable cash generator. They aren't working for the bank anymore. They are working for the shareholders. The debt to EBITDA ratios are compressing rapidly because the EBITDA is going up while the debt is falling.
And they have the liquidity to keep doing it.
Yeah.
They ended Q4 with total liquidity of about $1.5 billion. And the guidance for 2026 was really interesting, too. Usually companies are super cautious, but management explicitly said they expect 2026 free cash flow to meet or exceed 2025 levels.
Which is a massive signal of confidence. They're targeting year-end 2026 liquidity of $1.6 billion to $1.7 billion. But notice what they said about that target.
Right. It excludes opportunistic deleveraging.
Yeah.
They are explicitly telling the market they will use this cash to opportunistically pay down debt beyond their scheduled obligations. They only have about $380 million in scheduled payments, but they are going to attack that debt pile way beyond that.
And every single dollar of debt they retire transfers value directly from the enterprise value to the market cap. It's a levered equity play working in reverse.
It really is.
Yeah.
Okay, so the balance sheet is healing, the cash is flowing, but we cannot talk about this quarter without talking about the massive elephant in the room, the merger.
The Valaris acquisition.
Yeah, this dominated the narrative. It framed the entire earnings call. We're talking about a $5.8 billion all-stock acquisition of Valaris expected to close in the second half of 2026. This takes Transocean from a giant into an absolute behemoth.
It is a huge consolidation play, and you really have to look at the strategic rationale here. It is all about scale. You are combining Transocean, which is the best high-spec, ultra-deepwater floating fleet, with Valaris, which brings a massive fleet of jackups.
And that sparked a lot of questions on the call. Because, let's be real, Transocean has spent years trying to become a pure-play deepwater company. They got out of the jackup market. They sold them off. They said, we're deepwater specialists.
Right.
So why buy back into jackups now? Is this a complete strategy shift? Is the CEO admitting the pure-play strategy was wrong?
I don't think it's an admission of failure at all. I think it's an acknowledgement of market reality.
Yeah.
The jackup market is a different beast. It's traditionally shallower water, shorter contracts, and much more driven by national oil companies, or NOCs.
Yeah.
But management's take on the Q&A was very pragmatic. They have a history there. They know the business. But more importantly, Valaris runs that business incredibly well.
So it's a cash flow diversity play.
Exactly. Deepwater projects are lumpy. They are massive, multi-year, billion-dollar CapEx decisions by the operators. Jackups are much more transactional, a bit faster to turn over. Having that mix really smooths out the cash flow profile of the combined entity.
And let's talk about the synergies, because that's always the magic word in an all-stock deal. Management identified $200 million in cost synergies immediately.
Which is the low-hanging fruit. Duplicate public company costs, merging the headquarters, supply chain optimization.
$200 million seems really conservative to me. I mean, usually in these offshore mergers, the real number ends up being way higher. once they actually start the operational integration.
Right.
Are they sandbagging this?
Oh, almost certainly. Just think about the shore bases.
Right.
If you have a Transocean base and a Valaris base in the exact same port in Angola, you don't need both. You combine them, you consolidate the spare parts inventory. The real synergy number is likely much higher, but they are smart to guide low, under-promise, and over-deliver.
And what about the leverage targets?
Yep.
Valaris had a pretty clean balance sheet coming out of their own restructuring a few years back.
That helps the Transocean deleveraging story significantly. Management actually projects that the combined entity will reach a leverage ratio of roughly 1.5x within 24 months of closing.
1.5x leverage. That is investment-grade territory. That is a stable, boring, dividend-paying type of company metric, not a wild, distressed, offshore driller metric.
And that's exactly the goal, to make the company practically unkillable through the cycles.
And the customers seem to be totally on board. The CEO stated that customer feedback has been overwhelmingly positive, which makes sense, right? If you are Shell or Total Energies, you want your driller to be solvent.
Absolutely.
You don't want them stressing about making payroll. You want them worrying about drilling your well safely and efficiently.
Plus, consolidation helps industry discipline. Fewer players usually means better pricing power. If there are only 2 or 3 companies capable of drilling your complex deepwater well, they can dictate the day rate a lot more effectively than if there are 10 desperate companies undercutting each other.
That's a great point. So we have the cash machine, we have the massive merger. Now let's talk about the market itself, because none of this balance sheet stuff matters if the oil majors aren't actually drilling holes in the ground.
Yeah.
And this is where it gets incredibly interesting. We are seeing a real supercycle narrative forming in the data.
The macro backdrop right now is just incredibly strong. Management stated that utilization for deepwater is expected to exceed 90% all the way through 2027.
90% utilization is effectively sold out in this industry. Once you account for maintenance, regulatory surveys, moving rigs between countries.
Yeah, the transit time.
Right, transit time. 90% means there are literally no rigs available.
It means pricing power fully returns to the driller. And just look at the backlog. It currently stands at roughly $6.1 billion. They recently added $839 million in backlog at a weighted average day rate of about $453,000.
$453,000 a day. We are closing right back in on that $500,000 mark again.
We are, and remember, those are highly profitable barrels for the operators at current commodity prices. We are seeing a very clear pivot in the broader market from the energy transition spending.
Where they were almost apologizing for drilling.
Exactly, pivoting away from that and back to reserve replacement.
The oil majors are looking around and realizing they simply haven't found enough new oil to sustain their production profiles over the next decade. They have to spend.
They don't have a choice. You can't run an oil company without replacing the reserves you pump out. And the easiest place to find large, prolific reserves right now is deep water.
So let's go on a world tour here, because the earnings call gave us a region-by-region breakdown that was absolutely fascinating. I want to start with the biggest surprise of the call. India.
Oh, man. This was the jaw-dropper.
ONGC, the Indian National Oil Company.
They issued a massive tender for 3 drill ships and 2 semi-submersibles.
That is 5 floating rigs.
For 4 years each.
Let's just do the math on that. 5 rigs, 4 years. That is 20 to 25 years of rig demand dropping right out of the sky.
And your reaction, really the whole market's reaction, was justified. This was not in anyone's model. Analysts track Brazil, they track the Gulf of Mexico, they watch Norway. India has been relatively quiet. For ONGC to come out and demand that much high-spec steel, that tightens the global market overnight.
But where do those rigs even come from? It's not like there are 5 high-spec drill ships just sitting in Mumbai Harbor waiting for a phone call.
That is exactly the squeeze. They have to come from somewhere else. It sucks capacity out of the global system. If 5 rigs go to India for 4 years, those are 5 rigs that cannot bid on work in West Africa or Brazil.
It creates a massive game of musical chairs. But the music stops, and there aren't enough drill ships for the remaining operators. It's going to force the other regions to pay up if they want to keep their rigs.
So let's look at Brazil then. The absolute engine room of the deepwater world right now, Petrobras.
Petrobras remains the anchor customer for this entire industry. The big discussion there is about the blend and extend negotiations. Let's explain that concept for the listener who might not be deep in offshore contracting weeds. What exactly is a blend and extend?
Sure. So Petrobras has rigs on contract right now at lower rates that were maybe signed 2 or 3 years ago when the market was softer. The spot market rate is now much higher. A blend and extend means the driller and Petrobras agree to raise the current rate a little bit right now, but in exchange, Petrobras gets to extend the contract for several more years at a rate that is slightly lower than the absolute spot market peak.
So it's a mutual compromise. The driller gets more cash flow today and much longer visibility. Petrobras locks in a guaranteed rig for the long term without paying the highest possible peak price.
Correct. And Transocean expects these specific negotiations to conclude by the end of Q1. We are talking about adding significant multi-year backlog. It secures the cash flow they need for that aggressive debt paydown we talked about earlier.
Okay, moving across the Atlantic to West Africa. This is being called the growth engine right now.
West Africa is absolutely booming. Management expects the rig count there to go from 15 to over 20 very soon. And the real hotspot everyone is watching is Namibia.
Namibia is the darling of the exploration world right now. Talk to me about the geology there. Why is everyone so excited?
It's the Orange Basin. The discoveries there, specifically the Venus discovery by Total Energies, are just massive. We're talking about billions of barrels of recoverable oil. The geology is very similar to what we saw in Brazil's pre-salt layer years ago. It's an incredible new frontier.
And Total is putting serious money behind it.
They are. Total is launching a major tender for the Venus development. They want 2 rigs for 3 years each, starting in 2028.
And that's just the start for the region.
Right. In Nigeria, Shell just awarded a 2-year program. Exxon and Chevron are heavily expected to follow suit. Down in Mozambique, you have multi-year programs from Eni, Exxon, and Total, all starting in that 2027 to 2028 timeframe.
It really seems like every operator globally is converging on 2027.
That is the key date to keep in mind. 2026 is the transition year. 2027 is the wall of work.
Got it. Let's talk briefly about the Mediterranean.
Activity there is returning to pre-COVID levels. This is largely driven by regional gas demand and energy security. Egypt, Israel, Cyprus, they all need domestic gas. And that means offshore drilling.
Now, we do have to address the one soft spot that was actually mentioned on the call. The Gulf of Mexico, which is usually the premium market. Why is the Gulf soft right now?
It's a combination of a few things. Consolidation among the operators there, some regulatory pauses holding up permits, and honestly, just better efficiency. They are drilling the wells faster, so they simply need the rigs for fewer days.
Management specifically named a few rigs that might see some idle time because of this. The KG2, the Deepwater Proteus, the Deepwater Skyros, those are big, important assets.
They are, and seeing them potentially sit idle for a bit is never ideal. That burns cash. You still have to keep the crew on board, you have to keep the maintenance up.
But I noticed management's tone was very relaxed about it. They explicitly said that if the Gulf lags, they will just move their preferred assets to other regions.
Which goes right back to the India and Africa point. If the Gulf is slow, you just sail the drill ship to Namibia or India, where the tenders are flying around.
That is the beautiful thing about floating rigs. They float.
Exactly.
You can move the entire factory.
These assets are highly mobile factories. They go where the capital is. And because they are high spec, meaning they have the dual derricks, the high pressure blowout preventers, they are always the first ones picked for the complex jobs.
And finally, the harsh environment market. Norway and Australia.
This is a niche market, but it's an incredibly profitable one. You need highly specialized rigs to handle the wave heights and the extreme weather. You can't just take a standard drill ship from the Gulf of Mexico and drop it in the North Sea in January.
No, it wouldn't last. And utilization for these high-spec harsh environment units is expected to hit nearly 100% by 2027.
100%. That literally means if you are an oil company and you want a harsh environment rig, you basically have to name your price.
It is the tightest segment of the entire market. Okay, so the demand picture is robust, even with a little wobble in the Gulf. But what about the company itself? How are they actually running the ship? Let's look at the cost and efficiency narrative.
This is a part of the call that's often overlooked by retail, but it's crucial for the margin. Transocean achieved $100 million in structural cost reductions in 2025, and they are targeting another $150 million in 2026.
Where is that extra $150 million coming from?
Rationalizing shore-based support facilities, cutting general and administrative, the G&A expenses, basically trimming the corporate fat so that more of that top-line revenue falls straight to the bottom line.
But I have to ask the uncomfortable question here. $250 million in cuts over 2 years. Are they cutting into the muscle? Because if you cut too much, operations are going to suffer. If you fire the experienced maintenance guys on shore to save a buck, does the rig break down 6 months later?
That is always the primary risk in these massive efficiency drives. But if you look at the operational data they presented, the answer so far is a definitive no. Their operational excellence numbers were stellar this quarter. Uptime was just shy of 98%.
98% uptime on a machine that complex.
And zero lost time incidents. Safety was flawless.
That is remarkable.
It is. And in a tightening market, reliability is the actual product. If you are an oil major paying $450,000 a day for a rig, every single hour that rig is broken down costs you serious money. And not just the rig rate, but the spread costs. The helicopters, the supply boats, the specialized drilling engineers on board.
The spread cost can easily be double rig rate.
Easily. So a rig that works 98% of the time is inherently worth a massive premium over a rig that only works 90% of the time. Transocean isn't just selling a drill ship, they are selling reliability.
So they are leaner and they are running better.
All right, let's bring this all into the investor context. What does all this actually mean for the stock? Because we've seen a clear shift in the core thesis. The thesis has completely shifted from will they survive the debt load to how much cash can they print in the supercycle. Transocean is no longer a distressed trade. It is a pure scale and cash flow trade now.
So the EPS miss on the headline was just noise.
Completely irrelevant to the long-term equity value. The cash flow thesis was proven beyond a doubt this quarter.
And what about the idle time guidance? The fact that they might have those few rigs sitting in 2026.
It's a headwind, sure. You have to model it. But look at how conservative that guidance likely is. They are assuming idle time for the KG2, the Porteous, and the Skyros. But, as we just discussed, with the surprise India tender and the explosive Namibia activity, there is a very high probability those rigs find work.
Right, so if those rigs get contracts, the revenue guidance they gave the street is way too low.
Exactly. There is significant upside to the upper end of their revenue guidance if the market tightens the way we expect.
And they keep framing 2026 as a bridge year.
Right. 2026 is the transition. They close the Valaris deal, they integrate the two fleets, they pay down the debt, they prep the assets. All of this is specifically to be ready for the 2027 supercycle, where utilization hits that 90% plus mark.
So as an investor, you are being paid via the stock appreciation and the enterprise value shift from debt reduction to just wait. You're getting paid to wait for the real party in 2027.
That's exactly the setup.
Okay, that brings us to the part of the deep dive everyone waits for. The part where we take all this data, all this analysis, and we construct a trade idea. It is outrageous. It is entirely plausible, but it is definitively not financial advice.
We are just two voices analyzing a company. Do your own diligence. Don't blame us if you lose your shirt.
Exactly. Though if you make a fortune, feel free to send us a bottle of something nice. So here is the pitch for this quarter. The deepwater squeeze and synergy call spread.
Okay, walk me through the mechanics of it.
The core thesis is simple. The market is currently underpricing the ONGC tender in India and the blend and extend pricing power Petrobras has in Brazil. Everyone right now is hyper-focused on the merger arbitrage, the specific mechanics of the Valaris deal. But the real trade is the sheer scarcity of high-spec hulls in 2027.
So you are purely betting on the supply crunch.
I am betting on the physical steel. So the trade structure is this. You go long Transocean, ticker rig, but not just the common stock. You look at Leafy's long-term equity anticipation securities, specifically expiring in 2027.
You are buying time to let the cycle play out.
Right. I want leveraged exposure to that 2027 supercycle. And here is the kicker for the trade. I am betting heavily on the synergy surprise. Management guided $200 million in synergies from the Valaris deal.
Which is pretty standard conservative M&A guidance.
It's heavily sandbagged. Usually in these offshore consolidations, once they get in there, start scrapping older stacked rigs and consolidating the massive shore bases, the real number is often double that.
And that extra synergy would flow straight to EBITDA.
Exactly. And here is the outrageous prediction part. If harsh environment utilization hits 100% as predicted, and deep water genuinely hits 90%, day rates don't just go up linearly. They don't just slowly tick from 450K to 475K. They go vertical.
The classic hockey stick chart.
Yes. When there is literally one rig left in the world and two oil companies desperately want it for $1 billion development, the price goes to the moon. We are betting on a day rate super spike post-merger close. We are looking for the stock to re-rate not on a multiple of EPS, but on the pure replacement cost of the steel. Because if you tried to build these rigs today at a shipyard, it would cost an absolute fortune and take 5 years to deliver.
And Transocean has them sitting in the water right now ready to drill.
Exactly. It's a bold call, I know. You are betting on perfect operational execution and the macro cooperating. But the setup is certainly there in the numbers.
It's asymmetric upside. And honestly, that is what we look for.
It certainly is. All right, let's wrap this up and recap for the listeners.
So, Transocean missed on the headline earnings, but beat on revenue. But the real story that drove the stock was that they crushed it on cash flow. $321 million in free cash flow just in the quarter.
And the Valaris deal creates an absolute behemoth in the sector. They are locking up the market.
Debt is melting away. $1.3 billion gone in a single year. The fundamental balance sheet risk is evaporating.
And the market bought the pre-market dip for a very good reason. The smart money saw the actual cash, not the accounting noise.
And the supercycle is clearly forming for 2027. India, West Africa, Brazil. The demand is truly global now.
Keep watching the water, folks. As always, we are not financial advisors. Do your own research and manage your own risk. This has been Talk Tickers.
See you next time.
And before you go, just think about this. If replacement costs for these drill ships are 40% higher today than they were a decade ago due to inflation, what happens to Transocean's valuation when the market realizes you literally cannot afford to build a new competitor? See you next Deep Dive.